look at gold's performance relative and compared to other assets, its alpha generating, profit generating capacity. And if you look at gold's effects on the total portfolio performance, its beta in a portfolio, you'll see gold is absolutely worthwhile. And I'll run through some charts. Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:20 on the afternoon of June 9th here in New York. The smoke is clearing away, so things are looking up a little bit better, at least physically here. I wanted to talk about, is gold worthless? And I don't really want to talk about it, but there were several questions attached to our Tuesday video that related to that and related to simple things. And I think that there should be an amplification and clarification of some of them. The three comments that I picked out, one was, Jeff, people like David Ramsey seem to be the opposite of a gold pumper, and he says gold's a rock and it's worthless. Could you address this? Is gold a relic of the past? I'm going to talk about this a little bit today, and I hope to talk about it a little bit in a future video where I'll talk about John Maynard Keynes' famous quote that gold was a barbarous relic, which is actually not accurate about what he said. And I'll also talk about Lenin's famous quote that will line the public restrooms with gold in the future, and what he actually said in November of 1921. But that's another time. So there are various issues about gold as a relic of the past or its utility now. And Gold Silver asked about it, as did other people. Eric C. asked, I appreciate the video and analysis. One question, if gold and silver are not worth acquiring, then why are all the governments and central banks buying as much as they can? First off, I don't know who other than David Ramsey, and I didn't know who David Ramsey was until I got this question on Tuesday. And then I searched him and I said, oh, that's cute. I think he was being sued last week for $150 million for touting some company that a lot of investors said they thought was probably a scam. Anyway, so it goes. I don't know who's saying that gold and silver are not worth acquiring. Certainly not anybody from CPM Group. But we'll get into that, and we'll get into central banks. And there are a couple misunderstandings that are the bases of that question. And understanding the basics underlying the gold market, you realize that question, that's the answer to your question. And then Bradley said he seems to have forgotten a scenario that covers the price increase when the dollar becomes worthless. And it's not that we forgot it. We'll get back to this. It's just that the probability of the dollar becoming worthless, especially in the next 6 weeks, as I was talking about on Tuesday, is zero. And it's less than 1% for the next several decades. And if you're going to predicate your investments on the concept that the dollar is going to become worthless, you're going to die broke. Anyway, let's go. Now, before I do that, a little reality check. Someone called me this morning and said, hey, I heard that people have withdrawn 175 million ounces of kilobars from the COMEX's kilo depositories. And what do you know, Jeff? I said, well, I know that that's not true, because there are only about 420,000 kilobars that are eligible for use with the COMEX. And you can't take 175 million away from 400,000. So it's just, again, kind of worrisome, because people who are highly respected by gold and silver investors are going around saying stuff that I'm not supposed to say. It's psychotic. Anyway, let's get back. Gold and silver said, is gold worthless? No, it's not. And if you look at gold's performance relative and compared to other assets, its alpha generating, profit generating capacity. And if you look at gold's effects on the total portfolio performance, its beta in a portfolio, you'll see gold is absolutely worthwhile. And I'll run through some charts and show you that in a second. Problem's not that gold's worthless. The problem is you're wasting your life listening to guys who you ought not to be listening to because A, they either don't know what they're talking about, in this case, or they're misleading you or both. Now, you can't really read this chart, but this is a quilt chart of 11 different assets, including gold and silver. And maybe you can see the gold and silver, we kind of highlight it. And you can see there are times when gold or silver are the top performing asset in terms of capital appreciation from the start of each year since 2000 through the first quarter of 2023. And there are times when they're toward the bottom. We put a summary together so that you can see it, but you can see that there are a large number of times, in fact, about a third of the time, either gold or silver is the top performing capital appreciation asset class among these 11 things. And these 11 things that include everything from T-bills and cash to real estate to stocks and bonds, U.S. stocks, overseas stocks, U.S. bonds, overseas bonds. So you can see that gold and silver hold their own very well. If you look at a weighted performance average, gold as a single asset has a weighted performance index of 138, silver 129. If you put the two together, it's 267. If you compare them to other things, small cap equities from 2000 through the first quarter of 2023 actually had a higher indexed weighted performance index, as did real estate and large cap equity. And then pretty much everything else was down there. So you can see here, gold and silver hold their own as individual alpha generating, profit generating, capital appreciating assets. And they have for the last 23 years. Turning to the beta, you've seen this chart from our videos before. This is gold's optimal role in a portfolio historically from 1968 when the gold price was freed. This says through to 2020. It's actually through 2021 or 2022, probably 2021. And you can see that as you add gold to your portfolio of stocks and bonds, or stocks and bills in this case, initially you reduce the risk, the volatility of the portfolio's wealth. Your wealth becomes less volatile by adding gold to your portfolio. And the overall return over the past 55 years increases. When you get to about 25 or 30% of your portfolio or your wealth being in gold, then you start seeing that the risk starts rising, and it starts rising at a rate ultimately greater than the increased performance historically on a return. So 25 to 30% is that optimal amount of your portfolio, your investment portfolio, that should have been in gold for the optimal performance historically. Past performance is no indication of future performance. But 55 years is a pretty good period of time to look at. You always have to worry about somebody who'll say, hey, over the last 2 years or over the last 18 months, an asset has done very well. If you look at gold's relationship with inflation, the trade-weighted dollar, stocks and bonds and bills, you see that a very low correlation. The highest one is the trade-weighted dollar, which is negative 34%. Again, going back to 1970 when the gold price was first freed to float. You notice that the inflation correlation is only 8% over time. So while gold is a good hedge against inflation, it doesn't move tick for tick with inflation. Same thing with the dollar. Gold is a very good. Gold doesn't trade against the dollar. Gold trades against currencies. If people don't like the dollar but they like the euro, they'll move into the euro. If they don't like the dollar and they don't like the euro, they'll move into gold, which is something that you've seen over the last quarter century. Stocks and bonds, very low correlations. That's what you're looking for in a portfolio diversifier. You're not looking for something that is highly negatively correlated, that goes up when the other things go down or down when the other things go up. You're looking for something that is uncorrelated, because that smooths out the value of your portfolio by having uncorrelated assets in it. And investors agree with CPM Group that gold is not a worthless asset. That's why they have been buying historically large amounts since 2022. More investors in more parts of the world and more types of investors are buying more gold at higher prices for a longer period of time than ever before in history over the last 20 years. There were a couple of periods of time, 13, 14, 15, 18, 19, 2018, 2019, when investors pulled back from that. But overall, over the last quarter century, investors have been buying more gold. It's something that in November of 2000, CPM Group started talking about the gold renaissance, in which investors would buy more gold for a longer period of time than ever before in history, and that central banks would join them at some point later, and that gold was going to experience a renaissance in its stock demand. Investors and central banks buying gold and holding it as gold, as an asset in gold form. So gold is not a worthless asset. It has a lot of value for alpha generation, capital appreciation. It also has a lot of value for beta, for portfolio smoothing out. Now, other comments. Eric C. was talking about this. The short answer is, whoever said that gold and silver are not worth acquiring, I haven't heard that. I guess I have heard it, usually by a drunk in a bar. Certainly no one at CPM Group has ever said that. CPM Group wouldn't exist if we thought we were spending all of our time looking at worthless assets. We look at gold and silver and platinum, palladium, and other commodities because we know they're worth acquiring. And whoever said that central banks are not buying as much gold as they possibly can has been misleading you. I'll show you that in a second. So let's go through that. And then the other comment was Bradley, who was saying that that we'd forgotten this. No, we haven't forgotten it. We just do scenario planning, and we understand the currency markets, and we understand the global economic system, and we know that it's less than 1% probability that the dollar will be worthless in my lifetime. Definitely not over the next 6 weeks, the way we were talking about on Tuesday, and probably not for the next several decades. And I'll show you why. The dollar's not plummeting. I put this together. I'll show you the charts behind it. The dollar's not plummeting. The dollar's actually been relatively strong for the last several years. Central banks are not dumping the dollar. Central banks are not buying record volumes of gold. You've been misled by marketeers. They made a mistake. They saw some gold being purchased or being moved through a central bank side pocket. They assumed it was for monetary reserve purposes, and they haven't corrected their error. Central banks are buying more gold, but it's not historically high volumes. And central banks are not buying silver. Again, you got to understand the currency markets, relative liquidity and volatility. The dollar is in fact rising. The Turkish central bank, which has been a major buyer of gold for the last several years, actually sold more than 2 million ounces of gold in April, or I think it was, in a moment. This is the page from our Precious Metals Advisory for June, which came out last night. Yeah, our data goes through April. And Turkey sold 2.1 million ounces. Kazakhstan, for what it's worth, sold another 1 million ounces. So you actually had 4.2 million ounces of gold sold in the first 4 months of this year, compared to 6.2 million ounces of gold that was bought by about 15 different central banks. So your net purchases by central banks in the first 2 months of this year is a little bit less than 2 million ounces. China, because everybody likes to look at China, actually bought 2.1 million ounces over the course of the first 4 months I stand corrected. The Turkish and Kazakh sales, those are over the first 4 months of the year. Turkey was buying a lot of gold. Its economy is just gyrating all over the place because of economic issues and political issues within the place. It had been moving monetary reserves into gold. It had to sell 2 million ounces over the last 4 months because it ran out of dollars and it couldn't pay its trade. It didn't have enough dollars and euros in its monetary reserves to cover the net imports into Turkey. So they had to sell gold, which is fine because that's one of the reasons why you want to own gold. However, if you have your monetary reserves in dollars or euros, which are the more liquid foreign exchange currencies that are used for trade settlement, then you don't have to get scalped by selling your gold to raise the dollars to pay your debt, which is why a lot of central banks that had 75, 85, 95% of their gold monetary reserves in gold after the Bretton Woods system ended, decided to pay down, sell some of their gold, in some cases half of their gold, in order to have more currencies in their monetary reserves to defend their currencies against raids and also to pay their bills if they were net importers and needed currencies. So Turkey has ran out of dollars and had to sell some gold to raise dollars, which is why you want gold. There also has been issues. The Russians wanted the Indians to pay in rupees for the oil and gas that they are buying from Russia due to sanctions elsewhere, and there aren't enough rupees to pay for the trade. Yeah. South Africa's currency restrictions effectively reduced the rand's ability to be used significantly in foreign trade. And also preclude the concept of a BRICS currency, which is one of those tropes that's just totally wrong. Okay, the dollar. The dollar is the blue line. I pulled this chart from yesterday's Precious Metals Advisory. If you were a subscriber, you would have gotten this last night, as well as a lot of other stuff, including those tables that I just picked up on central banks, listing the central banks that have bought and sold gold over the first 4 months of this year. Trade weighted dollar, you can see it did hit a low around 2011 when the U.S. Treasury was downgraded for the first time in history. And that low was a little bit below 80 on a trade weighted index. And today it's up around 110 on the trade weighted index that we use in this chart. Yeah, that's down from where it was in 1984, 1985. It's higher than it was in 1980, 1979. So the dollar's not collapsing. And if you look at central bank holdings, about 58, 59% of those holdings are in U.S. dollars, and that's been relatively stable for the last couple of decades. So central banks aren't dumping the dollar. And the dollar represents roughly 60% of foreign exchange reserves, which is one of the reasons why you can't go to zero anytime soon. Central banks have been steady net buyers of gold. They bought about 10 million ounces last year. We expect them to buy about 10 million ounces this year. That expectation may be too high now because we're seeing countries like Turkey and Kazakhstan selling a lot of gold to raise foreign exchange, foreign currencies that they need to pay their bills. But right now we're holding that there. But last year was about 10 million ounces. It wasn't 20 million ounces. And you can see that since 2008, there have been 4 years where we had 16, 17, 18 million ounces of net central bank buying. So last year's 10 million ounces was not a record volume, nor was it the highest level in 40 years. You can go back and see prior to 1966 that central banks were acquiring, 15, 18, 20, 25 million ounces a year. And that's because they were using it for trade settlements under the Bretton Woods system when the gold price was fixed at $35 per ounce among central banks. So if you were a country and you were selling a lot of goods to be imported into the United States, which was the case in the 50s and early 60s, you were getting paid in dollars. And then you would take those dollars to the Treasury and say, you think the dollar is worth $35 per ounce, so here are my dollars, give me your gold. And that is that big spike down where you saw about 45 million ounces of gold come out of central bank coffers in 1967, and then another 22, 23 million ounces in the first 4 months of 1968. Before Lyndon Johnson closed the private sector gold window at the Treasury. So central banks are buying a lot of gold. They're not buying historically high levels. This is just the last 23 years. A close-up you can see from 2000 to 2010, you had this residual amount of gold being sold by those central banks that had bought a lot of gold prior to 1966. As I said, they had 75, 85, 95% or more of their monetary reserves in gold. If you needed monetary reserves, foreign exchange reserves, currencies to pay your bills or to defend your currency against falling exchange rate, you have to sell your gold in a relatively transparent market. Everybody would see you coming. They'd know why you were selling the gold. They would underprice you on the price that they would buy the gold from, and they would also continue to hit your currency because they knew that you were concerned about it, with the full knowledge that you were going to come in and defend the currency. There was this massive selling of gold as a result of the post-Bretton Woods system. That's this whole period really from 1970 until 2005. It was most intense after 1989 with the Maastricht Accord for those European central banks that were opting into the euro. I won't bore you with any more details there because I've already gone longer than I want to. And by 2010, most of that selling was behind the market. And you had other central banks that had not built up large gold reserves because they were major trading entities prior to 1971. They started buying gold to build up their reserves, diversifying their portfolio away from dollars, just as other central banks, older, more established, industrialized countries, were diversifying their reserves away from gold into dollars. We will be doing a question and answer open forum June 21st. It's open to clients, 11 a.m. online. If you're a client or if you become a client, which you can do at cpmgroup.com, you can ask questions, either write in the questions before the open forum or ask them during it. You can go to our website, become a client, buy our yearbooks, and look into other ways that CPM Group might help you understand these markets, understand what's going on in the world, and become a better investor or manager of your company's exposure to precious metals and other commodity exposure. That's all for now. Have a good weekend. Take care of yourself and those around you. Go out and do something good for us all. And pray for rain in the northeastern part of the United States.